Good morning. We have 8 people yet, right? Let's give 2 minutes time, then we will start. Hope everyone can hear me. Can you hear me? Okay, thanks. So we did type of customers, type of facilities. Today we will do the type of collateral we have. And next week onward, we will do the financial analysis part, where we will discuss the ratios and calculations and those things. Right? Is it okay the way I go? Is it clear to you? Okay, thank you. We have how many people? We have 10, 9 people. Let's start. Okay, we will be talking about collateral today. Collateral or security, whatever we call. There are 2 schools of thoughts on collateral. Why we need collateral? One school, they say, no, we don't need collateral. The best collateral would be the ability and willingness to pay. Right? We discussed 5 C's of credit. They are the first 2 are willingness and ability. That is the character and the capacity. Right? Then the other school of thought says, no, we need some sort of security for some products. Right? May not be for the all products, but for some lending, we need some collateral. So on the 5 C's of credit, collateral is the last one. So it is a different way of thinking. If you get the correct person, even without a security, we will get our money back. Why we need security is the insurance. It is a cushion against the credit risk. What is credit risk? Will I get my money back? It can be a depositor, it can be a lender. Like for a bank, when we give out money to a borrowing customer, bank is running a credit risk. I give my money, but can I get my money back? When a depositor gives money to a bank, depositor runs into a credit risk. Will I get my money? See what has happened to ETI, right? Swarna Mahal, the finance. Depositors has given money. Now they are not in a position to get as agreed. That is called credit risk, right? So collateral is a cushion, or it is the insurance against credit risk. It is a safety net. If they don't pay, we have the option of selling the collateral and collecting our money. Why it is important? Because we are giving out others' money, right? This money we lend is not our own money. It is depositors' money. Can you remember the first day? I gave you 9 best practices principles. of lending. What was the first principle in lending? Can someone tell me? What was the first on that list? Safety. Yes. We have to be very, very sure we are getting our money back. We are not going to lose the money. Right? So, this is the insurance, this is a safety net of getting our money back. Bank should never decide if, as a credit person, when we are going to lend, if you think that I will not get my money, I will have to realize the security, then only I can get my money, then you should never look at that lending. Right? Always it has to be the cash flow of the business. Right? Business is a going concern. Right? Collateral is only a second way out. We have first way out, second way out. First way out is through the business cash flows. Always, whatever the money borrowed, customer should be able to settle it through the business income. Right? So, we calculate something called debt service cover ratio, the ability to pay, DSCR. Or we calculate something called interest cover for short-term facilities. That is to look at the ability of a customer to repay through his income. That is the first thing. Then we calculate the collateral, asset cover. That is the second way out. If everything fails, we go to collateral. Right? Then this is the definition of collateral: property or other assets that a borrower offers a lender to secure a loan. If the borrower stops making a promised loan payment, the lender can seize the collateral to recoup its losses. Investopedia, this is this as the, so collateral is the insurance for non-payment. If you don't pay, we will take the collateral. Right? Lender has the right to seize the asset, sell it, and collect the money. Then, when you have collateral, we have a psychological advantage over the borrower. It is your property, you have given to us. If you don't pay, we will take. So, it is a psychological advantage. Like if property valued 10 million, you give 30 million, then there is no psychological, but it is a very slight psychological advantage. Property 10 million, you have given only 5, 6, 7 million, you have a better psychological advantage. If you analyze the bank portfolios, right, though we say, yes, we have to look at the cash flows before lending. If you have good cash flows, you don't need this. But if you analyze our portfolios, major portion of NPL cases are clean customers. Right? This is something to do with our culture as well. Our credit culture and the value placed to others' property is very, if it is mine, we try to protect. If it is not mine, is the Asian culture. You go to India, you go to Pakistan, you go to Bangladesh, everywhere. Public places, they don't mind. But if it's yours, we try to protect. So that is the psychological game we play by taking security, some solid security. You can take a lot of things as security, but solid security we are talking about. Then when you have security, bank is secured to some extent. So you can offer a lower rate. Capital requirement would be lower, risk return trade-off would be lower, right? So see, housing loans are at a lower rate, credit cards are at a higher rate. Why? Credit cards are clean basis, right? Housing loans are secured basis. So when you have security, the risk of the bank is low, so we can offer a low rate by the margin, right? Risk is denoted by the margin we keep, right? So when the risk is high, the margin we keep is high. Like you lend it to John Keys, then your margin would be smaller, right? When you lend to a micro client, your margin would be higher. Why? The perceived risk between these two are very high, differently high. Like John Keys has a very low risk profile, where the micro client has a higher risk profile. Therefore, the margin we keep would be different, right? Then categorization of collateral. Based on the behavior of the collateral value, we can categorize the collateral. Let me show you. Right, look at the board. You can see this, right? See. We take a graph. This is time. This is value. Right? We have some collateral where the value does not change, like cash deposits, FDs. Yes, value change, the value of money changes, but the face value does not change. Right? We call it stable security. Right? Security. With time, the value of the security does not change. We call it stable security. Then we have some security types where with time the value increases. Right? Increasing value. Right? Can you give me an example on increasing value security with time?
Land.
Yes, land, property. Right? With time, value increases. Right? Then we have decreasing value properties, decreasing value securities. Example? Machinery, yes, machinery. Then you have fluctuating value. Fluctuating. Yes, gold, any perishable item, stock in trade, those are fluctuating. Today, Apple stock can be some amount value, tomorrow it can be lower. When you have a stock where very high technical stock, like you think about Apple iPhones, if you keep a big stock with you, suddenly the Apple comes out with a new technology, are we talking about Apple 605 now? No, we don't. iPods we don't talk about now. Right? If you have a large stock, the value changes. Right? So these are the types of security we have: fluctuating, stable, increasing and decreasing value securities. Then if you take another graph, the same graph, time versus risk, it goes like this, right? With time, risk increases, right? With time, risk increases. So lending for 3 months is less riskier than lending for 5 years. Because we don't know what will happen. Look at a bus. First 2-3 years, it won't give problems. But after the 3rd year, normally you will have all sort of engine problems and body problems and everything. So the risk of getting your lease paid in the 3rd and 4th year would be higher than the first 2 years, right? And we don't know what will happen in the environment. Normally we predict, but with time environment can change. We don't know next year we will get a big drought. Then if we lend for agriculture project, we will have a issue. With time, risk increases. So whenever you are selecting security, the best practice is to link the risk of the facility and the security type. That means if you are lending long term, you should have where security value increases, because risk increases with time. You can have combination of these things, right? But you should never lend, like you should not lend 5-year term loan with a fluctuating security. There's no point, because we don't know, prices will change, right? These things will change. So it can be a combination, but not purely on this. See, these are very subjective. If you have a very good customer, right? These are gray areas. Like you can't have black and white, say, okay, if it is long term, we lend only with property. We look at a lot of factors. Security is only one factor, right? If the customer is perfectly good, cash flows are good, commitment is good, condition of the environment is good, then we may tend to go with the fluctuating. But as a basic principle, we should not lend with the stock mortgage for 5-year facility. It can be a combination of a property, then combination of stocks, combination of this. It can be a combination, right? So the best practice is to link the risk of the facility to the security type, right? Security type should be based on this. Always you should have a higher margin over the amount we lend at the start, beginning. Like that means if you are lending 5 million, you should take at least 6 million or 7 million security. If it is not stable value, right? Even if you take stable value, 1 million to 1 million, there is an interest component. So it is better to have a little margin over and above the amount we lend, right? Is it clear? Before I go to the slide. right? These are the depreciating, fluctuating, stable and appreciating value security. You go to slide number 49, you will have the detailed explanation on that, right? See, this is when the customer offers a 5 million FD over land worth 15 million as security for loan of 500, which one would you prefer? Definitely it's the FD because you have a liquidity, first one. Second one, it is stable value, right? Then we go to the attributes of security. These are the attributes of security: marketability, accessibility or measurability, stability, transferability and enforceability, absence of encumbrances. Let's go one by one. Marketability. When you take a security, why do we take security? It is an insurance. In a worst case scenario, on a rainy day, you take over the security and sell because you need to collect your money. Since the customer is not paying, you should collect. But when you take over the security, if there is no market, if it is not readily available for sale, no people to buy, then what is the use of this security? Right? So then always you have to think about marketability of a security, ability to sell faster, liquidity. Right? Security should be able to liquidate faster. See, you have I'll give you an example. Customer will give you a land of 200 acres, value something like 150 million from Mana. Or a customer will give 75 million worth land in Colombo. 10 purchase, 75 million in Colombo. Which one will you go? You have to give a 50 million loan. Which one is your preferred security? 250 or Colombo? I got one answer, Colombo. I told you when you are lending, you should have a higher margin on the amount you lend. Yes, because it is marketability of the security is higher when it is in Colombo and small. Like again in Colombo also, if you have a 10 perch land and an acre land, disposing the 10 perch land is easier than disposing the 1 acre land, because you can't sell a property even though you take over below the market value without the permission of central bank. Central bank won't give you the permission, right? Customer can come and complain to the court saying that bank has disposed my valuable property under market value, right? So always when you are disposing a property, you have to dispose at the market value, minimum of the market value valuation. So we do a lot of jugglery, that is a different case. But as of theory, you have to, right? So bigger the security, it is difficult to dispose. Right. Then we go to accessibility or measurability. Right? Any security will have a value. Any property, any tangible security will have a value. Right? But if there are subjective matters, right, in the property, then the value is very subjective. Right? I'll ask you a question. I will give you, I want a facility of 50 million. I'll give you the original Mona Lisa picture, painting, or I'll give you 100 gold coins, 100 or whatever the gold for the value of that. Which one will you prefer? Mona Lisa or gold? Painting or the gold? Gold. No artist here, right? All bankers. Okay, I have one. I have only one artist here. But it is very subjective, right? Because we don't know. It yes, it can be damaged. It can happen something. And again, the value for one may value it very big. For others, there is no value. I'll tell you a story. There was one newly married couple, and they went to when they got married, the girl's father gave a picture to them, right? And they hang the picture in front on the front wall, and they were happy. One day, this father came to the newly married couple's house, and he had to turn around the picture, right? It's abstract drawing. So how the girl and the boy read it is different from how the artist did it. So උඩයට මාරු කරලා අපේ couple එක හිතලා තියෙන මේක තමයි picture එක කියලා. So it is very subjective, right? Recently I met a person, like she was telling me, no, I don't do anything. I just sell some pictures once in a while. Her husband had a huge collection of original paintings. He was a collector, right? So this lady was offering me the pictures for security, for long-term facility, which I told I can't take because it is very subjective. And then recently I had a, like you may be knowing, out of all the Walauers we have from our king's time, 99% of Walauers are owned by foreigners now. So it happened, I had to be a part of one deal where the Walauer was sold by one owner to a foreigner, right? So the valuation came per square feet roughly around 25,000 to 30,000. Why? It is a historic value to this property. Okay. But for someone who is historical, who likes the history, who likes these kind of things, it's valuable. For someone, it may not be. That's why we destroy a lot of archaeological places, right? So when it is going to be measurable, measurability, subjective matter should be very, very small. Then you have a stability. If the price, if the value of the property changes, like I told you, apple, not the eating apple, phone stock, perishable goods, or stocks with high technology. Right? Samsung, phone stock. Tomorrow it may change. So you don't know. So you should not always carry a big stock. With price, with time, technology may change. So the value of this will change. So the stability of the security is a key function. Then transferability, ability to transfer from one to another. So it is 3 items under transferability: ownership transfer, ability to transfer the ownership, right? Sometimes, like BOI lands, it is not easy to transfer. It has to be an exporter, right? Freehold land or BOI land, we go for the freehold land first, because BOI, there are conditions. We have to adhere to those conditions when we are transferring. Transferability on ownership, then physical transfer. When the, like, it comes on machinery, when machinery is huge, bulky, transferring is very difficult. Then usage transfer, like think about a cement factory. There will be very few people who wants a cement factory. So if you take a security as cement factory as a security, transferability would be lower. So transferability is of 3 times: ownership transfer, usage transfer, and physical transfer. Then enforceability, ability to recall, right? Api mortgage එකක් ගන්නවා, like the mortgage, the ability to take over the mortgage. There are some conditions, like some facilities, there can be assets which can't give us security. There can be assets which are governed by government laws, right? There are some agriculture lands given to government, lands given to people, which you can't transfer it to anyone, or you can transfer only to your family members. So someone, then you don't have a clearance from the AG, GA, district secretary, we don't have a clearance to take. So this kind of things we can't enforce. Then absence of encumbrances. So we have a security, but there can be a KV at place, priority registration. So, or there can be a priority creditor, or it can be physically encroached, right? So these kind of things should not be there when it is a good security. So these are the attributes: marketability, measurability, ability to sell, stability, transferability, enforceability, and the absence of encumbrances. Is it clear? Is it clear? What happened? All are sleeping over. Okay. Then we go to the other one. Right? Security forever. Easy to value. It should be easily ability to value easily. Valuable, there has to be a value. Easy to charge, like ability to take a mortgage without any issues or any lengthier processes. Then realizable, it should be easily sellable, disposable. This part I told you. The current value of the collateral must give a sufficient margin over the amount of advance, rate of advance. Security should rise in value because the risk involved in lending increases with time. The best practice to relate the nature of the collateral to the nature of the risk bank has to undergo. Right. There are different types of securities: immovable property, immovable machinery, movable machinery, motor vehicles, stocks, guarantees, cash. Near cash is treasury bills and those bonds. Marketable gold also near cash. Marketable shares, those are stock, market listed shares, and bank guarantees. Right. Based on the Sri Lankan law, like is the English law, Roman Dutch law, anything on the ground, fixed to the ground, goes with the ground. Right? That is the theory behind immovable and movable. If a machine is nut and bolted to the ground, it is considered as immovable, not easily movable. Right? So it belongs to the ground. If it is easily moved, like it is on wheels or it is not nut and bolted to the ground, it is a movable machine. Immovable property can be of two types. How immovable, these are house property, land, we call it real property. Common type of real property, land, all those things. Always when we take a land property, land or common property, we have to have display a public notice. This is mortgage to the bank. Tell me how we are going to make a public notice on mortgage. Jayani, I will explain what. Right? Any idea how we are going to display a public notice on a mortgage? Caveat is a priority registration saying that I have a some connection to this land. The public notice is the land registry registration. Anyone can go to the land registry and check. Because in Sri Lanka, what we do is a registration of documents in the land. It is not the registration of lands. Though we say, yes, extracts, right? Though we say we register the land in the land registry, it is only a document. So anyone can go get and register a land registry extract anytime, right? But with the cadastral map and the certificates, now we are physically identifying the land, the entire lands in the area. Those are land registrations. What we currently have is document registration, right? So public notice is the land registry notice. Jayani, you had a question. Please explain the last point further. Which point is it? I was talking several things. Is it the absence of encumbrances? Right. Absence of encumbrances means Like when you have a land mortgage to you, there should not be any other one who is interested about it. It can be a physical encroachment. It can be a caveat placed by someone else. That means there is another party who is interested on. Or there can be a property or security given, but there can be a like stock mortgage given. But there can be a priority creditor. Then there is a encumbrances for the stocks. So there should not be any other party instead of us and the borrower who is interested of the item given as security. Is it clear, Jayani? Yes or no? Jayani? If not, I will explain it again. Okay. Any other questions up to now? Anyone else? Right. Then let's go. This part. These are the immovable property, land, building, plant, and machinery, solid security. This is the common security. Public notice of a mortgage against real estate is filed in land registry. We can take a title insurance, so you title insurance, and you can take another normal insurance. Title insurance is an insurance which takes the risk of any issues with the title. But in Sri Lanka, I don't think any of us has claimed a title insurance. They say if there is a title case, they will bear the cost of the title case. It is not a recovery mechanism, right? They will bear the cost of the title case. That's what title insurance says. But no one has received that insurance. Insurance to cover the damages from flood and other hazards. What is the insurance? What is BOI? BOI, Board of Investment. Right? Board of Investment. All the foreign direct investment will come. They will give, they have different zones, BOI zones. Katnayaka, Puggala, Pallekale, they have BOI zones. Right? So BOI Board of Investment, they own them, and there are a lot of facilities if you start a project within the BOI. So, but BOI, in order to become a BOI, you need to have different criteria met against future probable loss. Yes, insurance is a protection against future unseen, unpredictable events. But there is a thing called God's will. ගහක් කඩාගෙන නට මේ වාහනයක් උඩට ඒක ඉන්ෂුර් කරන්නේ නැහැ. අකුණක් ගැව්වට වාහනයකට ඒක ඉන්ෂුර් වෙන්නේත් නැහැ. Right? So it is a insurance is a protection against unseen, unpredictable future calamity. Right? So insurance we take. It can be a fire insurance, it can be a burglary, like that. We have different ones. But bank should be the assignee. The insurance policy should be assigned to the bank. I'll discuss about insurance little later. Personal property also you can take. Automobile, furniture, gold, jewelry, anything you can take. Those are person property. Then benefits of obtaining immovable properties. The value appreciate. Immovable property, mainly the land, real property what we talk about. The value appreciate. Solid legal rights, tangible, we know, we can see, touch, solid legal rights. Then we have the parate ability. Parate is a special power given to the commercial banks to acquire the property without going into courts. Right? We will discuss what is parate later on. Motivation on the part of the borrower, that's the psychological advantage we discussed. Easy to monitor. Yes, we see that. Always we can see physically. Peace in mind for the banker. But when you take this kind of security, it is very time consuming. You have to get the extracts, check the pedigree for 25 years, all those things. Then value depreciate. Very exceptional cases, value may depreciate. Like asset, if an asset bubbles comes, like what happened to our condominiums these days. It is not the asset bubble, it is the bad market at the point. Right? Asset bubble comes. Like we have lot of assets, but very few buyers. That is asset bubble. Right? Then you have a property adjoining a religious place built. Normally, properties adjoining a religious place has a lower value. If a cemetery creates, then again it goes down. If a high tension wire goes over the land, again property values comes down. Right? Then inability of the bank to find a suitable buyer due to various negative aspects of the property. Argamadamai. Kanattak gava property at tiyanwa. So if it is landslides are coming, it can be anything. Movable items, bank could create mortgage or variety of items, vehicles, vans, stocks, anything. Movable. It should be able to move. What is immovable machinery and what is movable machinery is stated here. I told you. If it is difficult to move, then it is immovable. It's nut and bolted to the ground, it is immovable. If it is easily moved, then it is movable. How to be secure? Machinery also, we have movable mortgages and immovable mortgages, right? Immovable mortgages, you go and register in the land registry extract. Movable mortgages, we go and register in the land registry. We have a book, separate book. On that we register. Right? Then we come to the advances against vehicles. You should have the CR book, certificate of registration. Then you should have a valuation, mortgage bond, and you go and register this mortgage bond and RMV. It does not give you any ownership right to the property. It is only mortgage to us. Right? If he is selling, there is a mortgage. You can't take over a vehicle since you have a mortgage. But if we are leasing, you have the absolute ownership. Then you can take over because you own the vehicle. Right? Comprehensive insurance. Like keeping the property insured is a responsibility of the credit officer. Stock in trade before that. Anything? Any clarification you want? Movable, immovable, and motor vehicle, facility against motor vehicles. Right? Since no questions, I'll proceed further. Right. Advances against movable assets stocks in trade, that is the security is stock mortgage. It is very, very high due to two reasons. First one, value can change. Second one, stocks are staying with the customer, not with the bank. And today's stocks can be there, tomorrow's stocks will be out of the production site or wherever. I had the case several years back. We have given a facility backed by motor vehicles, right? So we normally check those motor vehicles every month type. So on a Friday, we had gone there, check all the vehicles. We had 30 odd vehicles to us. So we checked the vehicles, it was there. On Monday, when we came, the vehicles were in the car sale of the customer. When we came on Monday, no vehicles. Everything has been shifted. So we couldn't do anything. Those are mortgaged to us, but now it is not there. It is a fraud. He should not do it, but we also can't do anything. We have to go to courts, prove that he has mortgage and he has fraudulently done this. Then we can take court order against the customer. Otherwise, we can't do it. So when you have stocks as security, it is high risk. How we take is, first you take a statement of stocks. Then you should inspect the authenticity. Again, you have to ascertain the marketability of the stocks. Right? There can be stocks given to us as mortgage, but value of the stocks is also high as per the statement, but there is no market. I'll tell you a story. We were evaluating a customer who is a agriculture equipment, tractors and all those things, spare parts dealer. He is holding a huge stock, right? Then, like, he is okay to give us the stocks as mortgage as well. Then I asked him, why are you holding this much stocks? Your turnover is not that big and you don't need this much stocks to have. No, sir, I have a stock. That time it was around, I think around 150 million or something like that. Right? I have a huge stock here, which I got each piece for 400 rupees. Stock is at that price. Now, when I try to sell it, people are asking a kilo for 400. So I don't feel like selling. Therefore, I'm keeping it in my stocks. Those are called obsolete stocks. If you happen to take that kind of a stock as your mortgage, that's the end story for a bank. So you have to take a stock statement. It should tally with the accounts. Then you should visit. Then you have to see the authenticity. I have this much stock here, like you got a vedana, there is no physical stocks there. Right? Then the marketability also, you have to worry. Like there are stocks in cool rooms. If you take that stock, what can you do? I have seen fish cold rooms. 3-4 years old fish. We go to 5-star and eat those fish, saying very good, but it comes from those freezers. Right? You can't do anything with those things. Right? Then when you are talking about stocks, we take a floating mortgage over the stock, because we can't have like A, B, C items are stock, because they can move, a similar stock can come in. So it has to be a float. Again, stock mortgages are registered at land registry book within 21 days of execution. There are two words. Right, this one. Okay, we come to this. When we are lending against stock, the percentage we lend is low. Maybe 30% of stock, 40% of stocks, not more than that. Why? The stock values may change, quality of stock may change, discounted value may change. Therefore, we will not, like if you back the land, if you are lending 70% of a land in stocks, we may be lending only 30% of the stock value. There are two words. One is floating lien and the floor planning. Floating lien is a floating mortgage. Customer owns the stocks, customer holds the stocks. Right? Bank does not have any control. But floor planning is similar, is the same as pledge. Customer owns the stocks, but possession is with the bank. It says ownership stroke possession. Whenever customer want to sell, he has to send me money, then only I will release. Way to evaluate stocks is resale and inventory turnover. I told you about the obsolete stock. When inventory turnover is high, we guess sometimes that there are obsolete stock in the stock details. Is it clear, the stock part? Any questions up to now? I can't see your faces, so I can't guess your facial expressions. Right? So I go to the next slide. Advance against account receivables. Account receivables are debtors. Like on your financial statements, you have the current assets, debtors, stocks, debtors, all credit purchases. What we do here also, we take a mortgage over lien over debtors. We have a bank statement, financial statement. So we take a lien based on that financial position. Right? When a customer sends money to settle their outstandings, we reduce the loan against that outstanding of our customer. When the borrower's credit customer send in cash to retire their debt, these cash payments are applied to the balance of the borrower. A, right? Chaturi, I will explain you. We have a borrowing customer here. We have a debtor here. Right? We have a debtor, borrower and debtor. So we take a mortgage over this is debtor book, bank. We give cash to the borrower. Right? When this debtor sends money through the bank to these people, what we do, we take, before giving money to the borrower, we take out this lend part, then the remaining money only we will give it to the borrower. So first we take the lien on debtors, then we give money to this customer. Instead of debtors giving money to them straight, they can give money through the bank to borrower. So in that scenario, we settle the loan we granted, and whatever the remaining amount we give it to borrower. Right? That is the facilities backed by debtors. So similarly, it is a book entry. We take the lien over that book entry. Chatri, what is the issue? It is the stock mortgage you are talking about. You are not clear about the stock mortgage? Okay. So now you are clear. Right. Thank you. Right. Again, in this scenario also, we look at the account receivable and account turnover. Account receivable aging means like we take the debtor position and we have to check how much is above 30 days, 60 days, 90 days, 180 days, like that. There can be a hardcore debtors. It is there on the book, but we are not sure whether we will receive that money. So we can't, no point taking that kind of a debtor book. If the debtor book is current, we can take. We will discuss this account receivable, turnover and those things next week onward. Advance against shares, that is the stocks, quota stocks and the debentures. So there we take irrevocable power of attorney, securities to be, then we have a slash account. That is the account as CDS is jointly with the bank and the borrower. So whenever the customer does not pay, bank has the power to liquidate those stocks in that account and collect money. So these days market values are fluctuating. Normally we give 30% of the stock value as lending. If it is 100 million market value, we give 30 million. Right? Here it says 35 to 40, but these days we lend around 30. Last week also I did the 100 million transaction. We lent only 30%. Right? Here in this case, this custodian account or the slash account is the key. It should be a like the borrower, it is under borrower's name, but bank has the right to recall those shares at any time. CDS will liquidate on the instruction of the borrower that is given through this share power of attorney. Personal guarantees, if a facility is Like if a facility is guaranteed by a personal, it is called a personal guarantee. If a facility is guaranteed by a company, it is called a corporate guarantee. If a facility is guaranteed by a bank, then it is a bank guarantee, right? Personal guarantees, when you are taking a personal guarantee, we have to look at several things. The income of the customer. Why are we taking personal guarantees? It is secondary in nature. If my borrower does not pay, the third party will pay. He says, if your customer does not pay, I will pay. That is the underlying theme behind personal guarantee. It is a if the customer does not pay. That means if your customer does not pay, I will pay. First, bank has to request money and try to collect money from the first buyer, a borrower. If you fail, you can come to me, right? So source of income is very much required. Then net worth, source of income, the ability to service, and the value this customer has. I don't have any wealth, but I have a salary, right? You have to have both. If otherwise, you can come and say, I don't have the salary now. If you know the wealth, you can liquidate that wealth and get our loan recovered. Secondary in nature, principal default, right? Joint and several guarantees. These guarantees are called joint and several or joint or several. Under joint or several or joint and several, right? Joint, several, two words, right? Jointly, it says we are responsible jointly for the amount. Abhitamo, 1, 2, 3 people, all are responsible for the entire amount, joint. Several, that I will be responsible only 1/3 of the loan. Earlier, maybe few years ago, we used to take joint or several. Now we take only joint and several. I am responsible individually or I am responsible jointly together, right? So it is joint and several. Bank can decide, if a case of a default, bank can decide, we say A, B, C, 3 people, whether to go against all 3 or go against 1. Bank will go against 1 person and try to collect. If the bank fails, bank will come after the other 2 people. They can't say 3 of us guaranteed, so I am responsible only for 1/3 of the loan. No. If you guarantee, you are guaranteeing with or without the other guarantors, I am paying. Right? Joint and several guarantees. The other para is the other one I told. Straight away you can go to one or to others. Nothing. Yes, there is a ratio. We take lower amounts like 30-40%, not more than that, because all those things are stock mortgages, debtor mortgages. Those are only feel good factors, right? Yes, debtor book is there, but the collection will happen from the customer side. Actually, we don't know whether they are truly in debt to this customer. Right? So there is a discounting factor. Always, any security, there will be a discounting factor, but stocks and debtor discounting factors are very low, very high discounting factors. Advance against debtors is factoring, rhythm, right? It is factoring is a, I told, we discussed factoring. It is a mechanism. Like you can take a mortgage over debtors and grant advance. I'm talking about mortgage over debtors and granting facilities. Factoring, you evaluate the customer, factoring or bill discounting, those things. Those are mechanisms we use. Right? Rhythm, okay? Is it clear, Rhythm? Rhythm, you are not answering. I have to go. Okay. Right? Right. Joint and several guarantees and indemnities. Guarantees are secondary in nature. That means if the customer does not pay, we will pay. Indemnities, I'm indemnifying. You don't need to go to the customer, I will pay. It is a primary security. If you give an indemnity, it's a primary. In a guarantee, the guarantor undertakes the liability on the default of the primary debtor. The guarantor says, if the principal does not pay, I will pay. Whereas indemnifier undertakes to principally responsible for the debt. Right? The indemnifier undertakes to be principal responsible. When you are signing an indemnity, it does not say that bank has to collect first from the borrower, then come to me. No. Bank can straight away come to me. I am taking the full responsibility of payment. Advance again corporate guarantee. There has to have a board resolution. Anyway, I told you that any communication between the bank and the company and a company is through the board resolution. Right? So you have to have a board resolution to say that we are guaranteeing. So the company who is giving the corporate guarantee has to be profitable and has to have a good net worth. Like similar to a personal guarantee, we are looking at the income and the wealth. In business also, it has to be profitable and net worth high. Re-registration now does not apply because if they give a old registration number, you have to check if this is not registered. If a company is not registered on the new, it can't operate. And normally we take guarantees on the same currency of lending. Why? Because of the fluctuation in foreign currency exchange rates. Advance against life insurance policy. We need to have original policy. Then we need to have an assignment. Borrower should assign the policy to the bank and it has to be registered with the insurance company. The bank needs the original insurance policy. Then the customer needs to assign the policy to assignee, that's the bank. Then this assignment has to be registered with the insurance company. So again the borrower needs to declare everything: age, the health condition, whether you are a teetotaler or everything you have to declare. If something happens and they die without declaring, insurance company will not honor the payment. So the bank should get the customer to declare everything as per the requirements. Then monthly commitment has to be done perfectly without any arrears, else the insurance company will not pay. Then we have something called surrender value. After 3 years, we can surrender the policy and take some money out. We can cancel and take the money out. So that value is called surrender value. Most preferably, we should lend only up to the surrender value. That means any given time we can surrender the policy and get that money. Otherwise, we will have to wait till the customer dies. Assigno is the customer who is assigning. Assignee is the bank who gets the assignment. Right? Is it clear? Is the insurance clear? No. Right. I can. Your first name is not visible. Your surname only visible to us. Right? See, insurance, like you can lend again, you can take a life insurance policy as a security. Right? I have a life insurance policy. I give it to the bank and take money. So in that case, what they say is original insurance policy should be there with the bank. Right? Then I should assign the value, money, the policy to the bank. And that has to be registered with the insurance company. If I die, money will go to the bank. If I don't die, bank can't go and claim money. If I don't pay, bank can't go and claim money. If I die only, they will get their money. Right? But I can't lie to the insurance companies and take a policy. Because if I die and if they find out that I have lied to the company, they will not give you money. Right? So you should not lie. Age should be given, health condition should be given. Then you have to pay the premium up to date. In case of a default, if the bank needs to take out money, insurance company will check whether they have paid the premium. If the premiums are not paid properly, insurance policy will elapse. Then surrender value. We have something called surrender value. After 3 years, any policy, we can return to the insurance company and say, no, I don't need the insurance policy. Give me part of the money I paid us. It is a very small amount, like that. So if the bank has that surrender value certificate, you don't need to wait till the customer die. So they can surrender the policy and say, no, this customer is not going to pay the rentals anymore. Please give us this money. If you lend within the surrender value, there won't be a problem. But it is after 3 years only you can get that money. Assigno, the life insurance, the person who has obtained the insurance of his life. Assignee is the bank who is benefited by getting this policy. Who assign? Right? Is it clear now? Yes, if the premium is not paid, we can't recover. Right? So always we take a standing order, right, for the premium. So utmost good faith include under assignment. Yes, utmost good faith include, but the thing is, insurance companies find out the fault always. I had a case where when the customer came for us, he was not the alcohol person, but he met with an accident, died. Then the insurance company found out he has drunk. Even we didn't know that his family people didn't know that he takes liquor. Right? So insurance started telling he lied, so we can't pay. So we didn't get the money. What if any claims made for any medical? See, if it is assigned to us as the discretion of the bank, like for vehicles, insurance, when you met with an accident, payment has to come to the bank. Bank can decide whether we are giving the money out or we are not giving. I'm talking about life insurance, not medical insurance. Life insurance has a maturity date, yes. So we have to look at those things. But when you have a surrender value, you can surrender the policy. If you lend more than the surrender value, you are taking the life insurance not to cover as a security, it is to cover the life risk of the customer. If the customer dies, there is no way of getting the money. Okay, clear? Anything else? Janardhani, clear? Yeah, you can lend less than the surrender value, then you don't need to wait till the maturity date. It is after 3 years you can surrender. Sarshan? Natini? Is your questions answered? Okay. Right? Then we'll go to this one. Mortgage of securities, mortgage or immovable property obtained from, right? Like you can take mortgages, immovable property and movable property. You can put it together and take one mortgage. Earlier we used to take. But when you go to courts for recoveries, that is very difficult. Right? So what we do now is segregate movables and immovables, two mortgage bonds. Always movable and immovable, two more. You give a 10 million facility, you decide how much to be secured from the mortgage, movable, how much to be secured by the immovable. So when you go to courts, you have to recover based on the mortgage value. You can't recover more than the mortgage value. Whatever money you get more than the mortgage, like you can take the interest part, but you can't take profits, right? When you sell the land, you have to take the mortgage value and the relevant interest and charges. Whatever remaining has to be returned. That is the law. So we segregate mortgage and movable and immovable securities. What is insurance? Insurance is the indemnity assurance against uncertain, unpredictable occurrence of future calamity. We told that. Insurance is something which can be purchased only when it is not raining and to be used when it is raining. This is an umbrella. Cover the risk, we take comfort of the umbrella. Umbrella which can be purchased when it is not raining and to be used when it is raining. All times we possession of an umbrella. Umbrella give us the peace of mind. Nathang give us maruno apita karanna deyanne. Important aspect to be checked on insurance policies, value of the policy and assets. So that is another point we have to face. Value of the property insurance, value of the property insurance values is 20 million. Our facility is 5 million. So customers want to take an insurance policy for 5 million. When it is undervaluation, when we go for claim, insurance company will say you have undervalued your property. So the claim will be prorated based on the undervaluation. Right? 5 million claim prorated, we'll get 2 million. Right? So your insurance value has to be the insurance policy has to be on the insurance value of the property, not the facility. Then secondly, you should have the policy perfect. That means location, whatever the description, assignments, bank names, everything has to be perfect. Renewal on time and assignment. These are required. You need to have the original insurance policy. Premiums has to be paid properly. Renewals has to be done properly. It has to be assigned and registered under the insurance company. All the description has to be properly mentioned. Value should be the market insurance value, not the property value. Sorry, not the facility value. Type of insurance policies, you have fire insurance, burglary, comprehensive, all covered ones, mortgage protection. Mortgage protection insurance is a insurance. If the customer dies, mortgage will be settled by the insurance company and the documents will be handed over to the customer's family. It is a protection against the life risk. Marine, those are import-export insurance. If the goods travel on sea, marine insurance will be their. Third-party insurance is if something happens to a third party, insurance will pay the third party. Those are normally motor policies. Then another problem credit officers face is the customers will come and say, my land value is this much, why should I have an insurance policy? Land value alone is 50 million. If the building is not there, also it is 50 million. I'm taking only 10 million. Why should I take insurance? I don't believe on insurance. But if there is an insurable asset on the land, we need to have an insurance. That is because if something goes bad and this insurable asset get destroyed, customer will have to rebuild it. So he needs money. If there is an insurance, they can use the insurance money and rebuild. Else customer will have to pocket out money to rebuild. Or else he has to come to the bank for money to rebuild. So customer will be affected. Make a ginigata, so the factory is not there. Now bank can't go to courts and take the property out. Right? So in order to restart the business, customer needs money. Therefore, insurance has to be done. The borrower will be compelled to seek assistance of the bank for future loan rebuilding. borrower will be out of business, will not be in a position to service the existing loan because the income source dries out. So always land value is higher. Why you need insurance is different thing. If everything goes bad, you take the property, sell. We are not Sherlocks. We don't need property. We need cash to come. That's all. So if something goes bad, customer needs to be protected, needs to restart the business, need to pay us. Right? That is the thinking behind insurance. Is it clear? Insurance? Okay. I got 1 year. Anyone know? Right. Then we have 3 words: lien, pledge, and mortgage. Right? None of these gives you the absolute right over the ownership over the property. Right? Under pledge, bank will have the possession of the goods. Lien, mortgage, all those things are merely a right. We have the right to take charge of that. But you need to have a process, follow legal process to take over the property. But under pledge, you have the possession of the goods. In case of a default, you don't need to go to courts. Though you don't own the goods, you don't need to go to courts to sell. You can directly sell. That is the difference between lien, mortgage, and pledge. There are various ways in which bankers obtain security. None of the above case entitle the bank to get the absolute title to the assets. Lien, the borrower will remain the owner of the asset on which the lien has been created. The owner and the possession is there. Pledge, in pledge, the bank is entitled to have its exclusive possession until the debt is settled and has the power to settle the pledge assets, though the ownership is vested with the pledger. A lien is a mere right to retain an asset, while an asset pledge could be disposed of without intervention of courts, provided it does not contain to the terms of agreement, contravene the terms of the agreement. So if it is pledge, you can sell without going to courts. All other things you can't. Fixed mortgages and floating mortgages. Right? You can see the board, right? Can you see the board clearly? Right. On a fixed mortgage, we give a facility, one facility of 10 million for 60 months. Right? So on the first day, we take the mortgage for rupees 10 million. Gradually, we pay and the facility over. Okay. So the mortgage also will be over. Mortgage value is there here. It comes down, down, down. Right? Outstanding value. Then mortgage will be over. On a floating mortgage, what happens is we will get a floating mortgage like this, 60, first month, 10 million. Right? We come to somewhere here, outstanding is 7.5 million. Right? This is the outstanding from here to here. This part $2.5 million customer has settled. Now you want to give another facility of up to 2.5 million. You don't need to take a new fresh mortgage. You can use the mortgage up to 2.5. If you are giving 5 million facility, this mortgage bond can be used for 2.5 million. Balance 2.5 million, you need to have a new mortgage. Right? Always before the original mortgage finishes, a new facility has to be granted. Once the original mortgage finish, you can't reuse. You don't give this facility here, wait. After this facility is paid out, you want to give a facility. No, you can't use. If you give it on 58th month, you have only 200,000 to pay. You can give a 9.8 million facility under the same mode. At any given time, the outstanding to the bank has to be within 10 million. But the second facility needs to be given before the end of the original facility. Again, you can give a 10 million and go like this. Before that facility finish, you have to start the third facility. So that is called a floating mortgage, revolving mortgage. This is called a fixed mortgage. Abhishek, what is your question? Okay, sorry. Secure particular liability and cannot be enforced for further advances. But for floating mortgages, a floating mortgage will enable the bank to grant series of advances within the specific limit. Right? That is floating mortgage. Then type of mortgages. Is new facility need to be settled within the previous facility maturity date? No. New facility needs to be started before the original facility lapse. Or like we give a facility of 10 million for 5 years. 59th month, you can start a new facility of 10 million. Less than 10 million, like remaining amount. Right? So the third facility can start before the end of the second facility. Like that, before the existing facility finishes, you have to start a new facility. Is it clear, Tarsha? No, you don't need to sign additional mortgage bond because you have a leeway. You have signed the mortgage for 10 million. You have settled 2.5 million. So balance to 2.5 million you can play. If you give more than that, you have to sign a mortgage for the balance part. You have a leeway of 2.5 million, but you need to give 5 million. So you use 2.5 million from this mortgage and 2.5 additional mortgage. Fixed mortgages, it is only for specific facility. If the facility finish, that is finished. Mortgage bond finish. You can't use it for other facilities. Floating mortgages, you can use one after other. Before the original one finishes, you can start a new one. Then before the second one finishes, you can start a third one, like that. Jonathan, clear? You had two questions. Are you clear? Earlier, we used to have fixed mortgages. Because by doing this floating mortgages, government is losing stamp duty, taxes. There was a time government did not allow us to give floating mortgages, right? But banks had to make a lot of representation and got the inland revenue approval. Yes, I'm coming to that. Fixed mortgages, you can give any amount of mortgages, right? It is specifically for a facility. Mortgage floating is for the bank. Within that floating amount, you can give different facilities. But fixed mortgages, it is the like if it is a term loan, it is only for that term loan, right? Then we'll come to type of mortgages. First mortgage, if it is time, okay, I'll put it to the other side. If this is the time, very first mortgage is called primary. We say the bank is Bank of Ceylon. It's the primary. The second mortgage we take, it is the secondary. Similarly, it goes tertiary, like that it goes based on the time where we register. We say this is registered in 2014, this is registered in 2016, this registered in 2019, like that it can go. You don't need to wait till this is finished. You can have another mortgages, right? So whoever has the primary mortgage will get the first priority. If the same bank, there is no difference between primary, secondary, tertiary, because one single mortgage. So now we say we have a Commercial bank. This property is worth 200 million. This is 15 million only. Now commercial bank wants to give a facility of 25 million. If they take a mortgage, it will come here after primary. It is a secondary mortgage, commercial bank. Secondary. Now, if the commercial bank facility is not paid, they have to settle the primary mortgage bank before taking the legal action. Even if they take the legal action, when they sell the property, primary mortgage bond has to be settled. They have to sell, pay the Bank of Ceylon 15 million. If remaining money, they can take. So always based on the primary, secondary, tertiary, first mortgage bond gets the priority. If it is secondary mortgage, primary gets the priority. If it is secondary, tertiary, secondary gets the priority. Right? So these are, if it is on the same bank, primary, secondary, tertiary, there is no difference. If another bank comes in, primary gets the first priority. In order to avoid, in order to get the same right for the Bank of Ceylon and commercial bank, we take something called concurrent mortgages. Concurrent mortgages. It can be a primary concurrent, it can be a secondary concurrent, whatever. Right? Those are called concurrent mortgages. Okay. So primary, secondary, tertiary. Primary is the first mortgage executed to secure the facility. Second rank in the subject to existing mortgage. We execute any number of mortgages. Concurrent mortgage is the mortgage created to secure facilities to two or more entities on the same level. Any mortgage executed to secure the advances subsequent to the primary mortgage covering the same property asset should have the adequate. When you are creating a mortgage, asset should have a value. Like asset value is 100 million, you are creating mortgages for 200 million, no point. Then we talk about something called third party mortgage. I'm taking the loan, my mother is giving a security. Then it is called third party mortgages. We don't have the parate rights for third party mortgages. Anyone can give the property for my loan, but then bank will not have parate rights. Okay, that's all I have for today. Anything to be clear? Primary, secondary stock mortgages, yes, we can take, but no point taking. Anyway, stock mortgages, taking stock mortgage is no point. Then we hardly take secondary mortgages. But if the same bank, you can take secondary mortgage, because there is no difference between primary mortgage and the secondary mortgage if it is the same bank. Right? What is under construction policy? You are talking about the insurance. Under construction policy is still the building is under construction. So there will be work in progress, there will be workers around, all those things are called under construction policy. When you finish the construction work, then it will become the fire policy or burglary policy, that one. Sir, in floating mortgage, when we do the additional MB before the loan finishes, is the first MB is cancel at maturity. No, we don't do an additional policy mortgage, right? Only we on the offer letter we say we take the mortgage bond dated this, like that. We don't do a specific additional mortgage signing. We don't do. We have one mortgage bond signed. On the offer letters we mention that policy, that mortgage bond only, right? There is no cancellation. Darshan, is it clear? Under construction? Okay. Any other questions? If no questions, we can stop. Or if you have any questions, you can ask. Mortgage bonds will be cancelled if the facility is finished. Yes. If it is a specific mortgage, it will get cancelled. Even if it is a floating mortgage, before the end of the facility, existing facility, if we don't grant a new facility, that mortgage will be collapsed. Janardani, clear? Any more questions? If no questions, thank you. We'll meet next week. Okay.